Welcome to Section 2 of the Payroll and Workforce Cycle series. This section answers the COO-level question that sits above everything else. What does your company need to have in place before it can legally pay a single employee or contractor? This is a one-time setup checklist, 9 steps, done at company formation, and revisited every time the company expands into a new state. Nothing in the employee or contractor processes can legally happen until these foundations exist. By the end of this video, you will be able to identify the 9 infrastructure components that must exist before any worker is paid. You will explain what federal and state tax registrations are required and why. You will describe how workers' compensation, benefits, and retirement plan setup work. You will know how to apply the new state expansion checklist every time the company hires its first worker in a new state. And you will recognize which steps are truly one-time and which are standing checklists. The starting point is the Federal Employer Identification Number, the EIN. Think of it as the company's tax identity, the way a Social Security number works for an individual. Every federal payroll filing, the quarterly Form 941, the annual Form 940, the W-2s issued to employees, and the 1099 NEC forms issued to contractors, all require the EIN. But the EIN alone is not enough. The company also needs active enrollment in EFTPS, the Electronic Federal Tax Payment System. This is the only method the IRS allows for depositing federal payroll taxes. Without an active enrollment, you literally cannot make a compliant federal tax deposit, even if the cash is sitting in your bank account. Here is something that surprises many first-time employers. The federal EIN does not cover state tax obligations. Separately, and before the first payroll run in any given state, the company must register for a state income tax withholding account. Each state runs its own portal, its own registration form, and issues its own account number, and that number is required on every state paycheck and every state filing. This registration is not a one-time event at company formation. It repeats every time the company hires its first employee in a new state, which means any remote hire can trigger it without anyone noticing. The State Unemployment Insurance Account, called SUTA or SWAY depending on the state, is separate again from the withholding account. Your SUTA rate starts at the state's new employer rate and then adjusts over time based on how many former employees filed unemployment claims against you. That rate directly affects your payroll cost. Alongside the SUTA account, federal law requires every new hire to be reported to the state's new hire reporting directory within 20 days of their start date, sooner in many states. This is not a payroll function. It feeds the child support enforcement system, but it is triggered by every new hire, and the registration must be active before that first report is due. Workers' compensation insurance is not optional in most states. It is a legal requirement before the first employee is hired. The company works with an insurance broker to bind a policy, and the premium is calculated based on estimated payroll by job classification code. A warehouse worker carries a different code than a software engineer, and the premiums are very different. The surprising part is the annual audit. The insurer will true up the actual payroll against the estimate at year-end and adjust the premium. If your workforce mix has shifted, more employees in a higher-risk classification, the adjustment can be substantial. Never assume a small employer exception applies without confirming the specific state's rules. With tax accounts and insurance in place, the company now selects its payroll processing method. The two main paths are an in-house payroll platform, ADP, Gusto, Paychex, Rippling, or a professional employer organization, where the PEO co-employs the workforce and files taxes under its own EIN. Either way, the configuration matters as much as the selection. Pay frequency, the general ledger mapping for every payroll account, which state tax jurisdictions are enabled. All of this is set up before the first run. And critically, The system's user access and approval workflow must enforce segregation of duties from day one. The person who sets up new hires cannot be the same person who approves payroll. Benefits design is a significant cost decision and a compliance trigger. The company selects its health, dental, vision, life, and disability carriers, usually with a benefits broker, and sets two key parameters: the employee eligibility waiting period and how much of the premium the employer will contribute. But here is the compliance piece most early-stage companies miss. If you expect to reach 50 or more full-time equivalent employees, the ACA applicable large employer tracking must be built into your HR system from the moment you start hiring. AL status triggers the employer mandate, the legal requirement to offer minimum essential coverage to full-time employees, plus annual Form 1095-C reporting. You cannot build this system retroactively once you cross the threshold. If the company offers a 401k, the plan requires a written plan document, a record keeper and administrator, and a documented employer matching formula. But the operational rule that catches companies by surprise is this: employee deferrals taken from payroll must reach the plan trust as soon as administratively feasible. For small plans, the DOL provides a safe harbor of 7 business days after the payroll date. Miss that window and you have a prohibited transaction, not a late fee, but a formal DOL violation that requires plan correction and carries an excise tax. Plans with 100 or more participants trigger an additional requirement: annual Form 5500 filing with an independent plan audit. Before the first payroll or contractor payment is posted, accounting sets up the chart of accounts. This seems like a routine accounting task, but the most important decision here is also one of the simplest misclassification detection controls available. Create a completely separate GL account for contractor and professional services expense, entirely distinct from any payroll account. When these are separate from day one, management can see contractor cost as a fraction of total workforce cost at a glance. If that percentage is climbing, it is an early warning signal. If a payment lands in the payroll account but was supposed to go to a contractor, that misrouting becomes immediately visible. Step A09 is the one item in Part A that is not a one-time event. Every time the company is about to have its first worker, employee, or contractor in a state it has not operated in before, this checklist fires. Register for state withholding and SUTA, confirm workers' comp coverage extends to the new state, determine whether a Secretary of State foreign entity registration is required. And this is the step most companies miss: identify which contractor classification test applies in that state. If you are entering California, New Jersey, or Massachusetts, the ABC test applies, and your classification analysis for contractors in those states may reach a different conclusion than it would in your home state. This checklist is what the employee onboarding flow and contractor engagement planning both trigger automatically. 9 steps stand between company formation and the first legal paycheck: EIN and EFTPS enrollment, state withholding and SUTA registration, workers' comp insurance, payroll system selection, benefits design, 401k setup, GL account configuration, and the new state expansion checklist. The employee payroll process and the contractor process both assume all of this infrastructure already exists. Nothing in those sections can legally happen without it. Keep A09 as a standing checklist and pull it out every time a remote hire or a new contractor engagement creates a footprint in a state where the company has never operated. Thank you for completing this section on company payroll and benefits infrastructure setup.